One of the reasons that people are so arrogant, particularly in America, that the dollar's status is not in jeopardy, and so that we can keep on running these huge deficits, we can keep on creating inflation, and the world's got no choice, right, but to stick with the dollar, because are they going to go to the euro? Are they going to go to the yen? The pound, the renminbi. I agree. All of those currencies also have problems. And so do you really want to switch from one flawed fiat currency to another, even if those other fiat currencies may be less flawed than the dollar, right? Do you really want to make that shift? I don't think that that's what's going to happen. What everybody is missing is that there is an alternative to the dollar that doesn't involve another fiat currency, and that's gold.
There's a new game in town. Gold stocks are taking the market by storm, and savvy investors are jumping on board. In this video, we'll explain why gold reserves are taking over the markets and why you should be paying attention. Welcome to my channel. In today's video, we are talking about why so much emphasis is being laid on gold this year, 2023, and we will be looking at what Peter Schiff has to say. For years, tech stocks have been dominating headlines and driving the economy. However, as we've seen in recent years, the tech industry can be volatile and subject to rapid changes in consumer behavior and market trends. Is gold a safe haven asset? Well, let's find out together as Peter Schiff schools us on why the gold stock is gaining popularity and how you should get started as an investor.
What I think should be going on right now is more people who are buying these tech stocks should actually be buying gold stocks instead, because I think the gold stocks are the new tech stocks for this new easing cycle. The people who are buying tech stocks all quarter were correct in their judgment that we were coming to the end of the tightening cycle, because we were. And they were correct to anticipate that there would be an easing, which there already has been. The Fed has already acknowledged that it's probably not going to hike much, if at all. And whether they want to admit it or not, they're back to quantitative easing. Although this week, on Thursday, when they reported the balance sheet, it actually shrank again by about 25 billion. So we didn't have a third week in a row of an expansion. There was a little bit of a contraction. But I think that is the exception, not the rule. I think going forward, we're going to see the balance sheet continue to expand. Every once in a while, there may be a weekly contraction, but the direction now for the balance sheet is up. But I think investors are wrong in thinking that this easing cycle is going to be good for tech stocks. I think they've got it wrong. The last easing cycle was great for tech stocks, but I don't think that we're going to repeat that. I think this time around, it's going to be gold stocks. And in fact, if you go back to the 2000 bubble that popped, and NASDAQ was down 80%, mostly because of those tech stocks, the tech stocks rebounded from 2002 to 2008 when we had the financial crisis. But the gold stocks did much better during that easing cycle, because the Fed moved rates down to 1% and then kept them there for a while and then gradually normalized. But during that entire cycle, the gold stocks actually did much better than the tech stocks. So I think the same thing is going to happen this time. It's not going to be the people in tech stocks are going to make money again like they did from 2009-ish all the way through 2021 or whenever that bubble finally peaked. It's not going to be the same, nor is it going to be the crazy days of the COVID lockdowns where all these tech stocks, went ballistic. Because what I think investors don't get is that inflation is the wild card, because it's not going back down. The last easing cycle was good for tech stocks because inflation was below 2%, at least the inflation that anybody admitted to, right? The Fed was below 2%. And so in that environment, it was able to get away with quantitative easing, low interest rates, and the dollar was strong during that time period. And so I think this favored the tech stocks. But I don't think this easing cycle is going to look anything like that, because what I think is going to happen this time is inflation is already well above 2%. And, we got some more inflation data on Friday, we got the personal consumption expenditure index, and contained within that number, there was a better than expected reading on inflation, but just barely. The core PCE, which is the least accurate and therefore the Fed's favorite way to measure inflation because it understates it the most, it was supposed to go up by 0.4 on the month, and it went up by 0.3. I mean, big deal, because 0.3 annualized is still way above the Fed's 2% level. I think it's right now, if it annualizes out, I think year over year, we're at 4.6% rise in the core PCE. You know, the core, right, that strips out food and energy, right, which was even higher. But even if you strip that stuff out and you go down to the core, you're still at 4.6% year over year. Yes, that was slightly better than the 4.7% that they were looking for, but it's nowhere near the 2%. But what's more significant about that is that that's where the year over year core PCE is when the Fed has stopped the inflation fight. It is no longer hiking rates, but more importantly than the rate hikes, it's back to quantitative easing. The Fed is creating inflation. The Fed is printing money all over again, and that just fuels the inflation fire. So I think we're kind of at trough inflation now. Maybe it gets a little bit lower, but we're not going to get anywhere near 2, and then we're just going to pick up momentum and head for new highs. And that is going to create a completely different environment for tech stocks and for gold stocks. I will continue talking about this after the ETF. That was up 29%. Remember, that was beaten down the most, and so it had an even bigger rebound as investors are again making the wrong assumption that this easing cycle is going to be a carbon copy of the last one, and so they want to buy the crappiest type names, the most speculative names, like the ones that are in that fund. In fact, getting to crappy speculative names, Bitcoin, as I alluded to earlier in my April Fool's joke, was up about 70% on the quarter. And I know all the Bitcoin guys are just, excited about this and bragging about how this is the top performing asset. In fact, the Grayscale Bitcoin Trust did even better. It was up 120% on the quarter. So the discount narrowed as some more people are betting, I guess, that maybe they might be able to get this thing to be an ETF and they'll be able to cash out at NAV or at something like that. But so the Grayscale Bitcoin Trust, which was down more than Bitcoin in 2022, has rebounded more than Bitcoin in 2023. And the Bitcoin story is a little bit different because not only is it rising with the other highly speculative risk-on tech names, but a lot of people in the Bitcoin community are reacting to this Fed pivot because part of the rationale for buying Bitcoin was similar to my rationale for wanting to buy gold or wanting to buy gold stocks, which was that I knew that eventually the Fed was going to pivot because I knew that its feigned inflation fight would create a financial crisis, and that the minute that financial crisis reared its head, the Fed would be forced to pivot in its inflation fight because it would become more concerned over the impending financial crisis. And so that is where we are. And so we've now got the unofficial pivot. I mean, the reason I'm saying it's unofficial is because the Fed hasn't cut rates. And even though it's done quantitative easing, it's kind of denying that it's doing it. And it's come up with these BS excuses why what it's doing is not quantitative easing, even though it's doing exactly what it was doing when it was admitting to doing quantitative easing. But you have to read between the lines. It's not that hard to do that, right? Because, there's a lot there and the lines are pretty wide. But you have to read between them and recognize that the Fed has already pivoted. I mean, you can't wait for an engraved invitation because by the time that happens, I mean, the prices of gold and things like that are going to be much, much higher, which is why I've been encouraging people to buy. By the way, gold itself was up about $140 an ounce on the quarter. We didn't close the quarter above 2,000. We poked above it a couple of times. we closed at $1,970 an ounce. So the markets are giving you an opportunity to buy gold below 2,000. I don't know how much longer that opportunity is going to be there, but I do expect to see a big move up in the price of gold, which is why I, really have been suggesting very strongly that those of you who have been on the fence regarding their purchases, get off the fence and make your purchase. Contact Schiff Gold and do that, or talk to the reps at Europe Pacific Asset Management about getting involved in the mining stocks through a separately managed account through my gold fund. And if you own Bitcoin and you didn't sell last year, sell now. You've got this great rally in Bitcoin. I mean, we're not quite back to 30,000, but maybe we're as close as we're going to get. We'll see. I mean, it's hard to know exactly when this thing is going to run out of steam. Maybe it's doing it now, but it's up around 28,000. There is a lot more optimism now in Bitcoin. I've noticed that. I think because that the Fed has gone back to QE, because everybody realizes that they're going to be cutting rates because we're embarking on a financial crisis. And the Bitcoin people think this is it. This is the moment we've been waiting for, right? No, it's the moment I've been waiting for. They've been waiting for it too, but they're betting on the wrong horse, because what this moment is going to do is expose the Fed. It's going to destroy the dollar, and it's going to result in more people moving into gold as an alternative to the dollar. They're not going to be moving into Bitcoin. People think they will, but they're wrong. But because other people still think that's going to happen, you've got this rally. So people who are in Bitcoin, you have an opportunity now to change horses and actually get on the winner and get off this horse. I know, yes, Tudor Jones said it was the fastest horse in the race, but I don't think it's in the race anymore. I think it's headed to the glue factory. So you got to get on the gold horse if you want a faster horse. So a lot of people, they did okay in Q1. They made some money in these tech stocks. They made money even in bonds, rallied a bit. But don't be lulled into a false sense of security. If you stay on that path, you are not going to make money. In fact, you could lose a tremendous amount of money. What's even worse, it's not just losing money, it's losing purchasing power. Because even if you don't lose your money is going to lose its purchasing power. So what you got to do is, again, read between the lines and the writing on the wall and change your portfolio. Foreign stocks, again, beat the U.S. stock market. They didn't beat the NASDAQ, but, they beat the Dow, beat the S&P. So the foreign markets are already doing better, but I think that they'll do even better in the later quarters of the year, particularly in the back half of the year relative to the U.S. market, when the dollar really starts to fall, and that gives a big tailwind to the non-dollar portfolio, and in particular, the gold and precious metals.
To sum up, investing in gold stocks is a great way to diversify your investments and reduce risk while still taking advantage of the potential rewards that come with rising precious metal prices. However, it is essential that you do thorough research beforehand so that you can make decisions based on what best suits your individual needs and objectives. I hope this video has given you some insight into why investing in gold may be a good idea for some investors, especially those looking for an alternative way to participate in potentially lucrative upside opportunities while reducing risk at the same time. If you enjoyed today's episode of the Economic Diary and want to stay informed about the happenings in our world today, please hit the subscribe button and remember to turn the notification bell to see more videos daily. Thanks for watching, everyone. Until next time.